So we talked about the DOM, right? This is what DAS's level 2 looks like. And this is probably one of the best versions of a level 2 that are out there. The level 1, again, is just the bid and the ask. These top two right here, your bet, your bid, your ask, and your spread comprises your level 1. This is your level 2, right? So no, they just get bigger. So Boyd, we'll talk about icebergs. So right now, if you are, since we understand that market makers are moving large shares, we know that they are incentivized by transactional potential, right? So kind of like moving all of the produce from the warehouse to the grocery store. What's in it for the warehouse? You know what I mean? There was a farmer. He made money. There's a grocery store. They're going to make money when they sell it. So how's the warehouse make money? Right? Well, they exactly, Gail. They make money by charging a delivery fee. Right? There's a logistics price, right? The cost of them going to, interacting with the farmer, getting the produce, storing the produce, and then moving the produce to where you're going, right? So they make money. They get commissions, right? Every single time you send a transaction, they're getting commissions. Right. And they get commissions in both ways. Every time you sell, they're buying. Every time someone else sells, they're buying. Every time someone buys, they're selling. They're always getting paid. So now think of it more that way. Imagine the market maker to be more of like an ATM or an automated teller machine. You know what I mean? You need, and think of almost like the inventory as like cash. Right? There is no inherent value in the movement of the cash, just like there's no value in the movement of the produce. Value in the movement of the produce. The value is in actually moving the produce, right? Like, I don't know, like, so I had an uncle that was a truck driver. He had a little small logistics company, right? He didn't sell trucks. Right? He put stuff on the truck and drove it places, right? That's what he did. He got paid for logistics. A market maker is a financial truck driver, right? They are moving large volume from one participant to another. And that is how they make money off of those logistic fees, the costs of business, right? And that's where they really want to make their money. So now that we know that where they're incentivized, this makes it much easier to understand why they would utilize the order book. Now, when we're talking about the terms of low floats, we know that the order book is a very scary thing in low float land, because if it's a low float, that means the specialists aren't holding any of it, right? So low floats are really dangerous, right? But so is a book like this. Both of these books show examples of what we would consider to be a balanced looking book, right? A balanced book is a book that has large orders in all or no directions, right? If your book is empty or if your book is littered, you should not trade the ticker. It will be choppy. It will be very volatile for no reason, right? Because with an order book like this, the market maker is showing, the market maker is kind of showing that they have everything they need right where they are, right? So if you're, imagine the ATM scenario. Imagine if you have an ATM out in the middle of the woods, there's no transactions being done, right? Or imagine your ATM being in the middle of a mall. Right? It's just not happening, right? There's no need to move the ATM, right? In one instance, there's a need to move it, but you have no idea where to move it to. That's your empty book. In the instance of like the book on the right here, you have a book that has so many orders on it. It's just pointless to even think about moving it. You want a book that looks more like this, right? I use the quote highlight feature in DAS to do this, but you want a book that has orders that are stacked in one direction, right? You want to see that in order for if we're going to move the ATM, which way are we moving the ATM? Well, why would they move the ATM away from the mall instead of towards the mall if they get paid to do transactions, right? In low floats, that's not true, right? In low floats, they don't have any order. They don't have an inventory, so they can't do transactions. So they're going to be terrified of the big orders, right? Because people are going to like make them to fulfill requests they can't do. This is why in low floats, we don't trade into big orders on low floats, but on high caps, you do, right? It's a completely different way of trading because of the book difference, right? Here's what a bearish order book looks like. Right? We have large orders deposited to the downside, right? And you can see here that even at near here, like we actually have order selling coming in right near the price.
Hello, Market Alchemists, and thank you for watching this video. We hope you enjoyed it. Please make sure to watch the next episode, and before doing so, like and subscribe.